Hello, this is Coach Mike from winning.coach.com. Going to begin with our weekly market overview video. I'm actually going to start here with the Nasdaq Composite daily chart. The COMP is how you type it into your broker chart. Some broker you got to put the dollar sign in there first. Anyways, kind of the potential here at a chart pattern we don't want to see if our overall sentiment is bullish. Now remember, this pattern is called a head and shoulders, but the head and shoulders is not a confirmed pattern until the failure of the neckline, which would actually be this bottom line down here. The one thing I'm looking for overall, the Nasdaq since March had a pretty good fall. A lot of the technology stocks that we saw doing very well in 2013 saw those falls as well. And over the past 2 weeks, what they saw was a very nice incline in price, but on very, very horrible volume. So, as far as a general analysis here of what we have on our daily chart, let's kind of face it here, and I'm going to draw on this chart while I'm talking to you. If we look at the general trend from 2013, it is not difficult for us to easily see and determine that that trend has changed. Now, with that, we need to kind of clarify that a trend changing does not mean the direction of the trend has changed. It does mean, however, that the angle of the trend has changed. You can get changes in trends and still be going in the same general direction, i.e. up, down, or sideways, but the intensity of that trend or the angle of it is a clear change that we see here. Now, I want to show you something else here that's, you can make of it what you want, but I'm going to draw on this here in front of you as well. I'm just going to use a channel tool, and what this tool is going to do is as I run a bottom line, it's going to run a parallel line for me. Now, with this channel, basically what you're going to see is that with that same trend from 2013, we had very, very consistent tops and bottoms. Through our January 2014 decline into that first week of February, we kind of got a failure of that channel. Now that's really ironic because we talked about this in prior videos with the RUT, the Russell 2000, the small cap index, and how the RUT had come and failed out of that channel, which can be taken as a technical indicator that your trend, or your channel in this case, is about to change. Now, of course, technicians of charts look at this and they say, but if we bounce, we're still going to play it, and it doesn't matter if it goes up, how far it goes up. We identify the potential at a change in the channel. Well, those people are made to look dumb, I guess you could say, in the short term, because what did it do? It goes up and hits a new all-time high. But really, that high is irrelevant here. Because let's look at this low here with the same channel tool in relation to the low that was made back in April. Let's run that same parallel off the top. And now looking at the potential channel that's made, one might say that even if it does go up, it may not go up as far as it did before, and we would now be in a downwards channel, even though it's a very slight downwards channel, kind of really close to that horizontal or flat channel. Now when we compile all this together, and we look at things such as our chart patterns, although that those that know about chart patterns and trade chart patterns would know that a head and shoulders would not be confirmed until it breaks below the neckline, this bottom support line. We have to identify what the chart is showing us, which is the potential at a setup for that pattern. So how do you apply that to your trading? Well, that's simple. You see, on Friday, we closed below the top horizontal line. Even though we kind of peaked above it momentarily, we did close below it, which indicates that the chart did see this line as a resistance point. When we apply that into our trading, we have to understand that positive beta stocks, on the average, will move in the direction of the indices. Negative beta stocks will move opposite to. And if we see the comp chart, the Nasdaq chart, breaking above this horizontal line, then we would be left to really assume that we will see upwards movement. But at this point in time, we would want to use this line here, once it breaks above it, as a support point. Now, when we talk about support and resistance on charts, resistance is a point that you may not break above. You could run up to and pull back. I'm trying to keep it as simple as possible. And a support point is a point in which you think it could hold, i.e. bounce up off of. Now, if you're long and you fall below your support point, it's really not a smart decision to remain long, because your assumption is that you would have to move down to the support point that precedes the one you were trading. Now let's talk about that in relation to this horizontal line here. If our Nasdaq were to come below this line, close below the line, thus failing the support, we would then be left to look at support levels much farther down as points that the chart legitimately could seek and bounce from. And it wouldn't be the best decision for our capital for us to remain in long trades during that time and just let our capital diminish. So for the short trader, how do you trade this? Well, just like the long trader would trade a move above here and then use this line as the support point, the short trader would use this line as your resistance point. Any negative movement in the week to come would give you an indication to enter your short trades, and this line, the resistance line, would serve as your stop, as in if the price went above, or really close above would be the important thing, that you would exit your trades or stop out, so that you would put your capital at less of a risk. Understand that the head and shoulders pattern, people can see it and be like, oh, that's a head and shoulders, but it's not until it fails the neckline. And until that point, it's only a pattern that has potential. And on that note, I want to switch over to the weekly chart for the COMP, our Nasdaq Composite, and show you why, there's a devil's advocate side to any debate. From November of 2012 until the current time, the COMP traded consistently. We've got 3 points within a trend line. And by June of 2013, we started to come off of that trend line considerably without ever really retesting that trend line until the more recent pullback there at the middle of April. So while our daily chart is showing us the potential that if it were to pull back, we would need to recognize that and trade smartly from that point. Our weekly chart is actually just showing us that the trend line people have been waiting on since late June of 2013 was finally reached again, which could actually be a very bullish indication, because simply the last time that it came off the line, it ran for 9 months. So very, very important points to be considered here as we watch our charts and plan our trades, because the differences that we're seeing between our weekly charts, our daily charts, that give similarities but slightly different perspectives, could be the key to the number of winning trades we're able to produce. We're going to switch over now to the small cap index, the Russell 2000, which was making a very similar pattern to the Nasdaq. And over the past couple of weeks, we talked about the upside potential the small caps could have. And a few weeks ago, it gave us a nice little burst that didn't hold. But over the past 2 weeks, we've had a nice steady climb in our small cap markets, our small cap stocks. But there's an important thing to also realize here, is though I still think that the index has higher upside than the others, it's still not doing anything to forcefully prove it wants to get there. When trading your small cap stocks and referencing your indices, I would definitely recommend, whereas a stop point before may have been this neckline as we started hovering around it, I would look more to the point of 1114.43ish, because of a particular chart pattern. It's just a standard W chart pattern that was made. And W patterns, where do you buy them? On the breakout from or on the retest of. So I would use that as a support point for my trading. If you've gone long in any small caps, if you see the RUT begin to fail that 1114.43 price, definitely start referencing the charts of the small cap stocks you're trading and begin to decipher the approaching support points that may be cause for you to stop out of the trade. That way you definitely approach things with a risk management strategy and an attempt to have a higher level of preservation on your capital. But again, with the RUT, I think there still needs to be a good focus with the small caps. I mean, small cap stocks, people are wrong when they think a small cap is like a penny stock or a $5 and under stock. The price per share actually has nothing to do with market capitalization. The market cap is based on a multiple of the number of shares and the price of the shares. And a small cap stock just means that market cap is between $300 million and $2 billion. As a matter of fact, stocks like Zillow, trading over $100, is a small cap stock. Yelp. There's a lot of small cap biotechs as well, and there's actually a lot of large cap stocks trading under $5. There's just more outstanding shares, so even though they're trading at a smaller price, their market capitalization puts them in those higher range categories. So you can easily Google the actual RUT composite list and see the different stocks that are on there that may have an interest to you when trading small caps in general. My big concern with the RUT heading into this week, and this might sound very, very simplistic, but it's green or red on Monday. Green or red on Monday. If it's red on Monday, I'm not going to look for any small cap long entries, nor am I going to look for any small cap short entries. Simply because on that W pattern I just mentioned, the first target point for a short is not very far away, thus making the risk or the reward not quite the multiple I'd be looking for in relation to the risk. If it goes green on Monday, there is some potential. I personally would think that the green move on Monday would ignore, in the short term, a couple high points here, and would at least get up to what would then form a right shoulder, like we're seeing on the Nasdaq, the COMP chart that I spoke about just a few moments ago. The reason is I think bears wanted to get there too. I think a lot of the move up over the last 2 weeks, everybody talks about the summer sell-offs, the summer sell-offs, the summer sell-offs. When we look at the fact that most stocks have been making lower highs and lower lows throughout 2014 at least, it's fairly easy to assume that the majority of people may have been short in those stocks. And thus that summer sell-off that we begin to see around Memorial Day could have actually been a short covering, which would explain the low volume that was seen on the markets. The stocks were going up, but nobody wanted to buy them. There was a covering of the shorts, or maybe even some stop outs for, to produce, to take out those stops and some acceleration with that. But it's actually very common when you start to see a sell-off of shorts, which is covering, which could produce a squeeze, a short squeeze type move, that unless others are convinced of the move, that volume will be very, very light. And the movement, though, will be presumably upwards, may not be a momentous upwards movement. And that's kind of what we saw over the last couple weeks. And when I factor that in with the fact that, as great as 2013 was, June was a horrible month. And I look at the fact that of the potential that people may take this up move to take their profits. So I'm a little hesitant going into this week. But I do know that if we were to move green in our small caps, the RUT, on Monday, that we do have a healthy support level that we closed just above on Friday, 1133.65, that we could use as our stop reference for long trades. We're going to move now over to the Dow Jones Industrial Average, the DJI chart, and I want to talk a little bit about a couple tools we've used for target projection, which has been very, very accurate since we've been covering the use of the tools in our market overview videos. And where we closed up on the Dow Jones Industrial Average on Friday was right at our first projected target. And that target was 16,719.64 cents. And we closed at 16,717.17 cents. Our high that was made on Friday, 16,721.22 cents, kind of makes our target a split in the difference between the two prices, the close and the high. It'll be very interesting to see how the Dow Jones Industrial Average starts out on Monday, because a red move from here would give us the indication that the tool accurately predicted a target price, and a pullback from it, you'd probably want to go to the same tool that accurately predicted the price, and you'd be looking in here at 16,326.35 cents as your potential pullback point. And I'll color that in red on my chart so it stands out a little more. I know there's a lot of lines in there and you might not be able to see it too well, but in many cases these lines are pretty necessary for understanding these charts. Now remember, from this high here, we did make a lower low here than was seen on the low before the high was made, which would give us the assumption that in a perfect world, which we all know we're far from a perfect world, that the stock would then make a lower high than the high that was made, but could go up to any value lower than that prior high. So I believe the DJI, as strong as it's been over the past 2 weeks, price-wise, not quite volume-wise, should it pull back through the beginning of this week, is actually just giving the shorts a phenomenal entry. So let's watch for some profit takers heading into the upcoming week that want to take advantage of this up move that many thought we wouldn't get into the Memorial Day time or into the start of the summer. And if we get that met by volume to support it, let's start riding the coattails of momentum and looking at some potential short trades. If you look at a couple DJI stocks, they kind of seem very well poised on their charts. They're right at resistance points. Stocks like Visa. And I guess for grins, I'll go to the chart here on the video so you can actually see it. Visa, lower highs, lower lows, indicated by this red trend line, closed right at it on Friday, or hit right at it on its high on Friday, and closed pulling back from it, while just barely breaking, yet closing below our Fibonacci target. Visa's a perfect example of a reference to the DJI chart and the potential that it could begin pulling back now that a mathematically equated target was reached. So if we start looking like a short, I think the DJI in the 30 charts that are associated, or the 30 stocks associated with the DJI, a lot of people say, oh, the Dow Jones Industrial, that's the market. No, there's only 30 stocks that make up the index. But those 30 stocks may poise the best short potential should the markets indicate a sell-off to be starting. And then there's that pesky S&P 500, who quite simply seems to defy gravity, who's hit our targets quite regularly, and now if traded with a support / stop point of $1,906.27, may actually have the potential to eventually reach this $1,950.17. Now remember, the S&P 500 is a composite index of 500 stocks like Facebook, for example, that, based on their beta ratings, trade in relation to the performance on the SPX chart. If there was one with still the momentum to, or the clear momentum to still trade upwards, I believe it would be the S&P 500, whereas the others need to break a certain point to give us that conviction. But closing Friday at an all-time high and reaching an all-time high in price as well, the S&P 500 could also present some incredible short opportunities, though they would be more risky, because for the confirmations, the proper confirmations to be given, you would wait on support failures, i.e. this 50% line, $1,906.27, which means you're going to be a little bit late to the party. But those that are more willing to take risks, that want to try to be the bottom players, well, remember the top of a chart would be the bottom of a short. And though I personally am not one to take those risks and want to jump into a short based on what I'm seeing here, others may see the potential of other things on the chart, such as this dark purple channel that you can kind of see coming through here, solid line, which is actually the top channel from the weekly chart, a parallel channel which was started in March of 2009 when the markets bottomed. Me personally, I think that based on my Fibonacci targets and the accuracy we've seen each week, in even the short-term targets being hit within 0.4%, 0.1% in many cases, that even if it were to get stalled by this line here, that it could just slowly trade up the line until hitting at or at least close to this Fibonacci target. And because of my belief in that, I don't know that I'll be looking for too many longs or shorts in terms of the longer aspect of trading, the time frame of your trades. I'll still be looking for shorter term day trades and maybe a couple day long swing trades based on what the charts show me. But I don't want to get stuck in an unmomentous move, whether it be up or down, because a lot of what I trade when it comes to the S&P 500 is options, which have an expiration date. And unlike a stock where you're only trading against price itself, with an option you're trading against the price of a stock and time. Options traders like stocks to go up, they like them to go down. Slow and sideways will hurt you. So you got to be kind of cautious on some longer term plays that, based on their beta ratings, will perform in relation to the S&P 500. Stick to those more traditional this week, watching the Dow Jones Industrial Average charts. I think the Nasdaq Composite, Nasdaq stocks, remember we have the Nasdaq exchange. The Nasdaq is an exchange. We have the New York Stock Exchange, which is an exchange. We have the Amex, we have OTC markets. And then we have indices, our S&P 500, our Russell 2000, our Dow Jones Industrial Average. And I think when we compile all that information together, we may want to be looking at, but not receive it quickly, trades to the short side on Nasdaq stocks held within the Dow Jones Industrial Average. This is Coach Mike from WinningStockCoach.com, wishing you the best of luck in the upcoming week with your trading. Please remember that if you go through, and I will do so very quickly with you here as we end up this video, we're going to take a look at just the last 5 years, a 5-year weekly chart, and we're going to go through June. And in June of 2009, we had a red month. And in June of 2010, we had a red month. June of 2011 was actually about even. We dropped for 3/4 of the month, but the last week of June came up to close the month about even. In June of 2012, we had another even month. And in June of 2013, we had a red month. If over the last 5 years the month has produced at best an even, I'd recommend you take a short-term approach to your trading. Not a short side to your trading necessarily. But don't allow yourself to get false aspirations of overdrawn targets. Remember that as you approach the summertime, the volume does slow up a little bit. They have that saying, sell in May and go away. Not because you should just sell in May and go away. As a matter of fact, I love the summers because I usually get my best entries for long-term trades, whether to the short or the long side, but my longer-term investments that I will be holding for some time. And I get those accumulation times during the summer, so going away is definitely not something I want to do. But understand that one of those markets to trade in that generally does not perform quality growth in your portfolio during the summertime is the OTC markets, your penny stocks. Generally speaking, the volume and movement seen in the summer times is not so great, but as you begin to approach mid to late August and into September, you begin to see that volume and performance pick up again. So it wouldn't be a bad idea to mitigate some of the risk in your trading with a cautious approach and maybe decreasing slightly your position sizes, which is a big way to mitigate your risk, and trade your charts that you wish to trade over the longer haul in relation to very simplistic trading systems of lower highs, lower lows, or higher highs, higher lows, and look to take smaller entries to start, and on your long trades accumulate on your position after each higher high has pulled back and moved to indicate a higher low. And should you do that, you should actually stay fairly safe and be quite happy, actually, with your results of summer trading. Best of luck this week. Best of luck over the summer. And God bless all of you.